Ladies and gentlemen, good afternoon from Jakarta, Indonesia. My name is Aucky Pratama, of the ASEAN Accountants, or AFA. I will be your of Chartered Accountants in England and Wales, ICAEW, Ikatan Akuntan Indonesia, or the Institute of Indonesia Chartered Accountants, IAI, and AFA. I would like to welcome you to the ICAEW IAI AFA Webinar Series 2020. Now, today's webinar is the first of the ICAEW IAI AFA Webinar Series 2020. It is a collaboration between the three professional accountancy organizations, providing our members and accountants, in particular the ASEAN region, access to the latest virtual development CPD activities. Now, before we start, I would like to invite you to observe the following housekeeping rules to ensure the effectiveness of our webinar today. To enjoy the full experience, we recommend accessing this webinar from your desktop or laptop. Access from your mobile phone will not allow you to pose any questions to the chat box provided in the webinar. Now, during the webinar, you may post your question into the chat box on the right side of your screen. The moderator will curate the questions and then discuss them with the panelists during the Q&A session. Now, during the webinar, you may set your video to full screen by clicking on the button on the lower right-hand corner of your video display screen. Now, should you run into technical difficulties, you may kindly email to our staff. Our team shall assist you to resolve any issues that you may have in joining this webinar. Now, finally, I would like to kindly remind you that this webinar is being recorded. Now, ladies and gentlemen, as of 3rd of May 2020, the World Health Organization of WHO reported more than 3.3 million confirmed coronavirus cases, with almost 250,000 deaths. Now, on behalf of our hosts, please allow me to extend our deepest sympathy to everyone who has been affected by COVID-19. Now, COVID-19 as a global pandemic is changing the way businesses are operating and individuals are living. Now, circumstances and priorities change. As we progress through the year, more information is coming to light on the scale and impact of COVID-19, including to financial reporting. Now, today, we'll be hearing from our three experts on the financial reporting implication of COVID-19 from an accounting and auditing perspective, particularly to businesses in Australia, Malaysia, and Indonesia. Now, our panelists will also share some information about policies introduced by governing authorities and measures taken by professional bodies in their respective jurisdictions to respond to the situation. Now, where appropriate, our experts will also share their insights on the regional and global impact of the pandemic. Now, each panelist will deliver their presentation for 20 minutes. Following the conclusion of the final presentation, I will then start our Q&A session for approximately 30 minutes. Now, I would like to remind you that you are welcome to post your question into the chat box on the right side of your screen at any time during the presentations. I do have to apologize in that not all questions may be entertained due to the limited time that we have for today. Now, please allow me to briefly introduce our panelists according to the order of their presentation. First, we will have Mr. Ralph Martin, Partner and National Technical Director of RSM Australia. He has over 18 years of experience in accounting and auditing and is an expert of financial reporting and auditing standards. Now, second, we will also have Mr. Simon Tay, Executive Director for Professional Practice and Technical of the Malaysian Institute of Accountants, or MIA. Now, MIA is the professional body for accountants in Malaysia. Now, prior to joining MIA, Simon was attached to PricewaterhouseCoopers Malaysia as an Executive Director with over 20 years of audit experience. And finally, we have Pak Djohan Pinnarwan, Chairman of the Indonesian Financial Accounting Standards Board, or the IAI, the financial reporting standard setting body in Indonesia. Now, Pak Djohan is also a partner of KAP Tanudireja Wibisana Rintis dan Rekan, or PricewaterhouseCoopers Indonesia, responsible for the Global Accounting Consulting Services and leader for the Indonesia Accounting Consulting Services. Now, ladies and gentlemen, without further ado, I would like to first invite our first panelist, Ralph, to deliver his presentation. Ralph?
Thank you. Thank you very much, and thank you for inviting me to speak at this presentation. Next slide. I guess the big impact of COVID-19 that I wanted to talk about is while the world's attention has been focused primarily on the medical impact, when you actually get to the detail, the impact for financial reporting purposes, for financial reporting and auditing, which is what I'll cover, is actually a result less of the pandemic itself, tragic though that is, and actually more of the economic measures that the governments have taken down to slow the spread of the disease. So what I'll talk today about is what's happened in Australia in respect of COVID-19. And then I'll talk about the financial reporting and auditing impacts. Firstly, the impacts for 31st of December 2019 financial statements, which certainly in Australia we are still very much working on at the moment. And then a little after that about the impact for later periods, in particular 31 March and 30th of June period ends. Next slide. The effect of COVID-19 has been relatively little, in that we've had a very low level of community transmission, and we've had less than 100 deaths in Australia. And most of those are either people who have come back from overseas, or we've had issues with several cruise ships, which have actually been the main sources of infection in Australia. The government's actually responded fairly quickly in terms of taking measures to contain the spread of the virus, and the measures it's taken have been particularly focused on international and interstate travel. Australia has closed its borders effectively not only to travel from overseas, but also to travel within Australia. If I'm sat here in Western Australia, if I want to travel to Sydney, New South Wales at the moment, I cannot do that. So the state borders are closed. And in fact, more than that, if I'm here within Western Australia, we've actually split up our state into 9 zones, and I cannot travel between those 9 zones. So that has been relatively successful in containing and indeed almost stopping the spread of COVID-19. For example, here in Western Australia, we're now on to our 6th day with no new cases at all reported in the state. But while it's been successful in stopping the pandemic, it has had a very significant impact on the economy, and in particular on the hospitality, tourism and leisure sector. So in terms of the economic impact, the stock market itself has fallen by about 25%, and what the government and the OECD believe is that roughly 20 to 30% of all economic activities shut down due to the lockdown measures. Another result is the GDP as a whole will fall 10 to 20% during the year. And I guess to give a comparison, the global financial crisis, as we call it, which occurred in about 2008, 2009, was 14%, and the Great Depression in the 1920s is about 30%. But I think the difference here is going to be the significance, the speed of which this happened. If you look at the 2 events I referred to there, they happened over the course of several years, whereas this happened almost overnight. So to combat that, the Australian government's put together a stimulus package worth around 210 billion Australian dollars. Again, by way of comparison, the stimulus package they did during the global financial crisis was around about $60 billion. So we're looking at 3 or more times that. But the biggest measure among those is what they call the JobKeeper subsidy, which is that anyone in an affected industry who suffered a fall in turnover of 30% or more, effectively the wages of the staff in that industry will be paid by the government for the next few months. So next slide, please. How does this affect financial reporting? Well, the short answer is it makes it more difficult. There's a lot of ways it makes it more difficult, but the 3 main themes I'd focus on, and I'll flow through the rest of what I have to say, is 3 on the slide here. Firstly, asset values clearly are going to fall. Any sort of investment, any sort of asset is going to fall, but it's very difficult and very uncertain to work out by how much they've fallen. Second thing is the effect of rapid change. Financial statements these days are full of estimates. if you go down a typical balance sheet, almost every number on that is to some extent an estimate. And the amount of uncertainty, because the situation is unprecedented, it's not really like anything we've seen before, the amount of uncertainty is significantly increased, so any estimate becomes more difficult. And normally how we do estimates, we look at historical financial information. If I want to know, for example, what level of provision to make for my bad or doubtful trade receivables, normally I'd look at how many of them had defaulted in the past. But suddenly that's no use anymore, because what happened 1 year ago or what happened 2 years ago is really no guide to what's happening at the moment. I'm almost flying blind here, so information becomes obsolete very rapidly, and really I can only base my estimates based on what's happened in the past 1 or 2 months. And the result of those two things, the increase in uncertainty, is really that disclosure within financial statements becomes a lot more important. Sure, I'm going to have to make an estimate. My estimates are probably going to be wrong because I just don't have enough data to make reliable estimates, but I have to make estimates nonetheless. So what becomes really important is the disclosure of the key assumptions and the narrative within my financial statements to explain how I've got to the result that I have done. Next slide, please. Now, what other measure governments in Australia have taken is actually to extend reporting deadlines. I will say that we have been perhaps a little less generous than some other countries in how far we've extended deadlines. So far, ASIC, which is our regulator here, for companies with 31st of March and 31 December year ends, they've given them 1 additional month. Now, private companies in Australia only get 4 months to report normally, which is actually a fairly tight deadline by international standards. So that's been extended to 5 months. Similar increase for not-for-profits, but most companies, the vast majority in Australia, have 30th of June year ends. About 90% of Australian companies report on 30th of June. And so far, no decision from either the stock exchange or the regulator about whether those deadlines will be extended. So let's talk about the impact on financial reports, and start by talking about 31st of December 2019 financial reports. Now, the position that we, and I think pretty much every other major firm has taken, is that while COVID-19 did exist at 31st of December 2019, there were a handful of cases in China and possibly in some other countries. Really, because the main impacting event is actually the measures taken by governments in response to it, it is a non-adjusting event at 31st of December 2019. And what that means is we don't make adjustments to report results, we don't restate asset values, we don't start making provisions for future losses. As a result, we keep our results as they were for 31st of December 2019. And there's really only 2 things we need to consider. The first is our subsequent event disclosure. And subsequent events is normally something we probably don't spend a great deal of time on for most financial reports. But actually what we've seen for 31 December 2019 financial statements is it's a critical disclosure. We've had a lot of discussion with our clients about exactly what we put in there. I think the message we generally give is you don't have to try and estimate the full impact, because no one knows, no one can reliably say what the impact is going to be for the next year or 2 years of COVID-19. What you can disclose is what's happened to date. Have you seen a major fall in sales to date? Have you had to shut down part of your business or cease production? Have you had to lay off a significant number of staff? All of that sort of thing can and should be disclosed in the subsequent events note. The other thing that requires very careful consideration is, of course, the going concern assessment, because that has to be done at the date of signature of the financial statements. So we've seen a significant increase in the number of clients that either have to disclose a material uncertainty relating to going concern, or in some cases actually have to disclose more than that. They may end up in situations where the going concern basis may no longer be appropriate. Those are really the only 2 impacts on 31 December 2019 financial statements. So let's talk about what happens at 31 March 2020 and 30th of June 2020. Next slide, please. So as I said earlier, asset values is a crucial part of what we consider here. And it really goes back to the definition of fair value in IFRS 13. I've put the definition on the slide, and I'm sure we're all familiar with it. But let's pick out some of the wording within that definition. So it's price paid for an asset or liability in an orderly transaction. Orderly transaction. So normally in a market where there's a willing buyer or a willing seller, but neither is in a forced or distressed sale position. Now that becomes difficult to judge in the present market, because actually a lot of market participants, a lot of people buying and selling any particular asset, may be distressed sellers. They may have no choice but to sell. And therefore the data we rely on to determine fair market value may no longer be so reliable. And the other thing to think about there is the IFRS 13 also talks about highest and best use in the most advantageous market. Again, that can be difficult if I've got a particular asset and I normally ship it across borders to sell it. If I have some machinery or some inventory and I normally ship it to another country, my supply chains or my distribution chains may have broken down in the present environment. So I may no longer be able to consider that. So a couple of things we've had to consider. One is that you do have to measure at the reporting date. You can't factor in any expected or indeed actual recovery. If you're a 31 March balance date reporter, you have to put the value of asset at that date, even if it's subsequently increased. The other thing we've been having a lot of discussion about is a lot of entities that revalue their property, plant and equipment will typically do so on a 3 or 5 year cycle. They'll obtain independent valuations, and in between times may do directors' valuations or may just assume that the previous valuation is close to fair market value. That assumption probably doesn't hold true this year. So there may be a need to consider out of cycle valuations. Problem we've been seeing there is a lot of valuers are actually very reluctant at the moment to put their name to a number. And if they do give a number, it's maybe just a range, and it may be quite a wide range, which certainly as auditors often has limited value as audit evidence. So if you are looking at out of cycle valuations, make sure you're having a conversation with the valuer to make sure that they are willing to give a valuation, and they won't be disclaiming or putting other statements in their valuation report which effectively render it worthless as audit evidence. So that's for assets held at fair value. What about assets held at cost? Well, clearly impairment's a big issue, and the reason it's a big issue is because of the requirement within the relevant accounting standard, IAS 36, for assumptions used in impairment testing to be reasonable and supportable. And that's difficult in the present environment where there isn't a lot of supporting data, there isn't a lot of market information for what the new normal in the COVID-19 environment looks like. But a few reminders to think about. One is that what we've generally been seeing is that just doing one forecast of how I think things are going to look in the future probably doesn't really work in the present environment. There's just too wide a range of possibilities. So it's often necessary to do something like a worst case, a best estimate, and the best case scenario, depending on the severity and length of any restrictions imposed by governments. Reminder that when we do impairment assessments, we shouldn't factor in future restructuring costs that are only possible. And similarly with government assistance and stimulus packages, governments often announce a lot of things in speeches and the like, but until all of the detail is actually legislated, it's in law or regulation, and the entity in question knows they will be able to benefit from it, then we don't think you can reasonably expect to include that in your impairment assessment. Generally, if you look at what forecasters are saying, the effect of COVID-19 will be ongoing for some particular time. Governments may end shutdowns and lockdowns, but that doesn't mean the economy is going to get back to normal overnight. Most commentators think there'll be a 1, 2, 3 year period. So we would certainly be looking for that to be reflected in any impairment assessments. And the last point on discount rates, again, in a lot of jurisdictions, central banks have cut borrowing rates, so the risk-free rate falls. But what we've generally been seeing is that in most instances that's counteracted and indeed outweighed by an increase in the risk premium applied by lenders to most companies. So in most cases, discount rates that are used in either fair values or impairment assessments actually have to increase in the current environment. A couple of reminders when looking at inventory, and one is obvious, one is less obvious. Firstly, net realisable values. Inventory, of course, we all know is lower of cost than net realisable value. There's a significant potential for net realisable value to fall in the current environment because of reduced demand and price falls. But the other thing we've seen that's easy to overlook is for companies that are in manufacturing or distribution type businesses, how overheads are allocated into inventories. And of course, variable overheads should be based on actual cost, but fixed overheads should be based on normal capacity. So for a lot of entities where they've had to significantly increase, reduce or stop production, they now have the same fixed overheads but much reduced production. Just a reminder, those overheads cannot be allocated in full into the inventory that is being produced. You have to allocate it based on normal capacity, and any difference goes to the income statement. So there'll be an immediate hit to the income statement. Conversely, in some manufacturers, and it might be manufacturers, if you imagine someone producing something like protective equipment, face masks, or indeed things like toilet rolls, which have had a surge in demand here in Australia, they may be producing suddenly much, much more than usual, in which case they would still allocate overheads based on normal capacity and actually get an immediate credit to the income statement. Quick reminder about expected credit losses. Hopefully everyone's already familiar with the expected credit loss model in IFRS 9. I'm not going to go into a lot of detail other than to say that when we look at expected credit loss, normally we based our expectation on historical data, on historical collection rates. But in the current environment, that's probably no longer relevant. Your collection rates for last year and the year before are probably not a reliable guide for your expected credit losses in future. So what we've generally been seeing is, firstly, you have to estimate an increase, but usually there's a need to stratify or subcategorize your receivables into different categories, and it'll often be based on industries. Some businesses may have been relatively little affected, and you wouldn't have significantly increasing expected credit loss. But then you may have to carve out, for example, all businesses in travel, tourism, hospitality, and leisure, and significantly increase the expected credit loss in those areas. May also have to consider whether there's government moratoriums on debt collection and insolvent trading. Certainly in Australia, we've had a 6-month moratorium on being able to place companies into insolvency for non-payment of debts. So that's obviously going to make it a lot harder to collect debts, and that will in turn impact the expected credit loss model under IFRS 9. One of the things to consider as we flow through this crisis is actually insurance receivables. A lot of businesses will have insurance for losses due to natural disaster or indeed loss of profits. But we expect there to be quite a lot of dispute around what is and isn't in the scope of insurance claims. Some insurance may have force majeure or similar clauses, and insurers may argue that they are not liable, therefore, for lots of profits. So I guess a reminder here that insurance receivables can only be recognised when they meet the virtually certain test. They're virtually certain to be received. And that'll usually only be when the insurer has actually accepted the claim and confirmed that they will pay. So what that means is there's often a timing difference between the recognition of the expense, probably in the current period, and it may only be in a subsequent period, 1 or more years in the future, where they actually access the insurance receivable. So that leads to greater volatility in the income statement. Again, the answer to that is usually through disclosure of the nature of any insurance claim, and perhaps as a contingent asset within the notes to the financial statements. One other thing that's happening right at the moment is proposed amendment to IFRS 16 leases. One of the things that's happened in Australia is there's what's called the National Mandatory Code of Conduct for Commercial Property. And what that says is it effectively enforces that landlords and tenants enter into negotiations for rent reductions for the period when either lockdowns enforced or there's significantly reduced trade. And what the IASB have done as an emergency measure, and it's still in the exposure draft phase at the moment, the comment letter actually closes on Friday if anyone still wants to make a comment. We'll certainly be commenting in favour as an international network. I know that because I'm the one drafting the submission. But what the amendment says is that rather than having to go through the process of working out that whether it's a modification under IFRS 16, and the modification requirements of IFRS 16 are complex, you just take any rent reduction due to COVID-19 within 2020 as a variable lease payment. What that effectively means is you take it straight to the income statement, a credit to your P&L in the period in which it occurs. So you keep an eye out for that, for whether that does go to the IASB, but I would say with 99% certainty, I think it will. It's a short-term emergency measure. And that will significantly change the way that lease amendments and rent concessions are accounted for. One of the themes coming through everything I've been saying is how much the importance of disclosure. And we'll certainly be looking at this very carefully in the financial statements that we're preparing and auditing, that it's not just a matter of getting the numbers right, but significant changes to disclosure will have to occur this year. That rolling forward last year's boilerplate disclosures won't work here, particularly when you look at the requirements to disclose key estimates and judgments in IAS 1 or the disclosures around financial instruments in IFRS 7. So just an example of a few of the disclosures to consider on the slide, and this is by no means an exhaustive list. What government support is available and how effectively does the entity think they will access it? Availability of cash, resources and finance, think around the liquidity disclosures in IFRS 7 in particular, and any breaches of banking covenants, which we expect to be very common. Also some disclosure around market risks, and in particular the ability to renegotiate rents, staff costs or other overhead expenses. So I've talked about financial reporting, but I did want to mention briefly, as I know we have a lot of auditors on the webinar today, how does this affect audit? Well, as financial reporting became more difficult, I think the same is true of auditing. It became a lot more difficult because of the amount of uncertainty and the number of estimates and judgments involved. Certainly, same as last year in terms of assessing risk assessment and understanding of the business will not work. There's going to be a significantly increased number of significant risks due to the different business conditions. And a lot of businesses have got to go from a situation where they operated at a particular site in a very short time to a model where a lot of their staff may be operating remotely or working from home. So that often has a significant impact on the control environment and the control activities in place. And what we've been seeing for some clients is effectively we have to plan the audit as almost two separate periods with two separate control environments and two separate control activities. The other thing I would emphasize for auditors in particular is the standard setters and regulators have been very, very clear that while auditing may be more difficult, there is absolutely no relaxation in any of the standards or in the requirement to obtain sufficient appropriate audit evidence, that actually effective audits and timely and reliable financial information and the assurance that an audit gives is still just as important, or in fact more important than ever. So certainly no relaxation in the amount of evidence that's required, and therefore it's likely that we will see a significant increase in the number of audit opinions that are modified, both in terms of the availability of audit evidence and in particular in terms of the level of uncertainty around going concern and whether there's material uncertainties, or in a lot of cases actually a material uncertainty may not be enough. We may actually have to consider something stronger than that, whether it's a disclaimer due to an inability to determine whether an entity should prepare on the going concern basis, or even an increase in the number of accounts being prepared on the liquidation or other basis. So I guess the overall message is tough times ahead for both auditors and preparers. but I would emphasise the importance both of early communication with auditors and of focusing on the need for disclosures as well as working out just the numbers in the financial statements. So thanks very much. That concludes my presentation, but do feel free to send your questions through the chat feature, and I will endeavour to answer them as best I can when we get to the Q&A session.